Warren Buffett, the stock market is about to make history. Depending on how you date it, the bull market is set to become the longest in history. Barring a breathtaking plunge, the bull market in U.S. stocks on August 22 will become the longest in history, and optimistic investors argue it has miles to go before it rests. The bull market has thrived amid a decade of financial and political upheaval, thanks in part to the all-you-can-eat liquidity feast hosted by the Federal Reserve and other major central banks. Now the Fed has shifted to a tighter monetary policy regime even as the same risks that have dogged this market over the years, including elevated valuations, persist, prompting some pundits to predict an imminent demise of the bull. But strategists led by John Lynch at LPL Financial argued that the U.S. market still has plenty of upside. From tariffs to trade wars to inflation to a flattening yield curve to a global economic slowdown, the headlines continue to cast doubt on the sustainability of this economic cycle and bull market. Although we see several potential stumbling blocks, we continue to believe this economy and stock market rally have plenty of fuel left in the tank, said Lynch, in a note. The underlying strength in the market on the back of government spending, robust earnings, and improving confidence is expected to carry stocks higher for at least another year, if not longer, he said. One core reason for Lynch's upbeat outlook is that he does not see the same types of excesses prevalent at previous market peaks, including obvious signs of recession. There are several reasons we don't expect a recession soon. One is that the past 3 recessions were preceded by annual wage growth of more than 4%. Recent data showed wages growing at 2.7% year over year, suggesting inflation remains tame, he said. The strategist also stressed that the Conference Board's leading economic index, which has turned negative ahead of every recession dating back to the 1970s, has risen an impressive 5.8% year over year recently. While this bull market and economic recovery may very well be old, adding it all up, we see few signs that suggest an end is near, said Lynch. Since March 9, 2009, which marked the low of the crisis and which many consider the birth date of the current bull market, the S&P 500 SPX, plus 0.64%, has advanced 320%, the Dow Jones Industrial Average DJIA, plus 0.45%, has risen 286% and the Nasdaq Comp, plus 0.65% has soared 521%. However, not everyone agrees that the bull market began in March 2009, with some arguing that it is best measured as beginning in March 2013 when the S&P 500 took out its pre-crisis closing high and others contending the current run began as recently as February 2016. A bear market begins when prices falls 20% from the bull market high. Meanwhile, 2018 may be the year when popular investing mantras, most notably sell in May and go away, are turned on their heads. So far 2018 has defied convention with the S&P 500 climbing almost 7% since the beginning of May. To be sure, a near-term stock market retreat may not be completely out of the picture given the typical seasonal weakness in August and September, but investors should view these dips as good opportunities to buy, according to Lynch. The S&P 500 closed in the green in April, May, June, and July of this year, something that has happened in only 10 other years since 1950. In each of those years, stocks closed higher over the final 5 months of the year every time, he said. His sunny outlook fits with bullish projections from other Wall Street strategists such as Stephen Sudmeyer, technical research analyst at Bank of America Merrill Lynch, who believes the S&P 500 could test 3,000 as early as 2019 given the market's similarity to the bull market of the 1950s when interest rates started to rise from their lows. 5 reasons the stock market will soar to new highs. The stock market has rallied in recent months despite a growing list of negatives that include tariffs, trade tensions, rising interest rates and valuations that are still high by historical standards. Jack Ablin, co-founder and chief investment officer of Crescent Wealth Advisors, sees the market breaking out to new record highs, based on 5 indicators, per an interview with CNBC. One of these is momentum, about which he said, "A market in motion tends to stay in motion unless otherwise acted upon." You look at something just as simple as the 200-day moving average. We really haven't even crossed below that even with 2 or 3 downdrafts this year. So, all in all, momentum signal suggests to you stay in this risk-on position for now. In addition to momentum, Ablin also cited positive signals related to valuation, the economy, liquidity, and investor psychology. Jason Hunter, a technical analyst with JP Morgan, sees the S&P 500 racing ahead to a value of 2,950 by late summer or early fall, based on his reading of the charts, per another CNBC report. Meanwhile, the current bull market is on the verge of becoming the longest ever, according to Michael Hartnett, chief investment strategist at Bank of America Merrill Lynch. Valuation. Ablin asserted that, taking a more shorter-term view based on forward P/E ratios, stocks actually are relatively cheap. He noted that, despite an increase of about 26% in S&P 500 earnings, the index is up by only around 6% so far this year. While acknowledging that earnings growth can't continue at this pace, he nonetheless believes that investor skepticism has led to a little bit of a discount going on. The economy. With US GDP growing at an annualized rate of better than 4%, and most key economic indicators delivering positive signals, Ablin cited these as key drivers of future stock gains. "We are still beating economists' forecasts, and the economic environment is still conducive for risk-taking," he observed. Liquidity. Regarding the amount of money available to borrow, spend, or invest, Ablin said, "We're actually squarely back in the middle of easy money again." Liquidity is a major prop to asset prices, and he notes that declining liquidity generally has been an early warning indicator, but often with long lead times. For example, he noted, liquidity fell over the course of 4 quarters prior to the 2008 financial crisis. Investor psychology. The degree of bullishness or bearishness among investors is a widely used contrarian indicator. While some surveys point to worrisome levels of bullishness right now, Ablin countered, investors are skeptical. It's not an extreme. They're roughly in the second quartile of their bullish-bearish range towards the bearish range. The skeptical view. While Ablin gets upbeat signals from his key indicators, others disagree. Longtime market watcher Mark Hulbert recently listed 8 indicators of his own, with strong predictive ability based on history, that paint a very different picture of rampant stock market overvaluation and excessive investor confidence. Among these is a valuation metric favored by Warren Buffett. Even if stocks do manage to advance to new record highs, if this is not the result of fundamental concerns going away, such as those related to trade, economic growth and asset valuations, the risk of a subsequent market plunge will not have gone away. Meanwhile, a growing list of investment professionals and stock market pundits have been issuing bearish warnings, the most ominous of them coming from John Hussman, who foresees a market crash on the order of 60% down from the highs. Michael Wilson, chief U.S. equity strategist at Morgan Stanley, sees a false sense of security in the market and expects a big sell-off, the worst since late January and early February, to be imminent. Test your skills with trading challenges. Put your trading skills to the test with our free stock simulator. It's the ideal platform to get your feet wet in the markets. Submit trades in a virtual environment with $100,000 in cash before you start risking your own money. Sign up today and start interacting with other traders from diverse backgrounds and experiences, and learn the methods behind their trades to become a smarter investor. Goldman lays out a scenario that could see the stock market surge. Goldman Sachs says several clients are asking what will happen to the stock market if trade tensions ease and economic growth stays strong. We were surprised this week when several investors actually struck a different chord, positing optimistic scenarios relative to our starting forecast, Goldman's chief U.S. equity strategist David Kostin says. Under such a bullish scenario, Goldman's estimate for S&P 500, 2019 earnings per share would rise by 3% to $175 and a lower than expected treasury yield would enable a market price to earnings multiple of 18 times. This would lead to a year-end price target for the S&P 500 of 3,150, 11% higher than Friday's close. Goldman Sachs predicts the markets will not move much into year-end, but some of the firm's clients are saying the S&P 500 could rally sharply higher. The firm said the second quarter corporate earnings season was stellar, with 25% year-over-year earnings per share growth and a sales increase of 12%. The best earnings season since 2010 is now mostly behind us. Investors have quickly shifted their attention from past results to future prospects at both the micro and macro levels, Goldman's chief U.S. equity strategist David Kostin wrote Friday in a note entitled "The Most Out of Consensus Question We Received, What If Activity is Better Than Everyone Expects?" Investors remain concerned about trade and tariffs, the note said. However, we were surprised this week when several investors actually struck a different chord, positing optimistic scenarios relative to our starting forecast. Kostin reiterated his year-end price target of 2,850 for the S&P 500, representing 0.6% upside from Friday's close. The strategist looked at what would happen if trade tensions fade, the Federal Reserve stops raising rates after 2 or 3 hikes and economic growth continues to rise. Under such a scenario, Goldman's estimate for S&P 500, 2019 earnings per share would rise by 3%, to $175, and a lower than expected treasury yield would enable a market price to earnings multiple of 18 times. This would lead to a year-end price target for the S&P 500 of 3,150, 11% higher than Friday's close. But even if the market doesn't dramatically rally, Goldman Sachs gave its clients several stock ideas that can outperform in a flat market environment. Given our forecast for decelerating U.S. economic growth, investors should focus on stocks providing the fastest top-line growth, he said. Our sector-neutral basket of S&P 500 stocks with the fastest consensus 2019 sales growth has outperformed S&P 500 by 3 pp this year. 5 stocks in the basket have more than 25% expected sales growth.